Short term, yes. We think there's pretty poor asymmetry now in risk assets and equities in particular, given the very powerful rally that we've seen and somewhat disconnect between that and the macro data, which is deteriorating even relative to the consensus expectations. So I think in the near term, we would see more downside in equities, but we don't see them going back to or breaking the previous lows that we've seen in this bear market. Longer term, I think there are opportunities, but as with all asset classes, I think we'll see lower returns moving forwards with less room really for valuation expansion.
Looking at some of the returns from different markets, Peter, around the world, the U.S. versus Europe versus China, Japan, I mean, is it as simple as go where the stimulus money is flowing the most, both fiscal and monetary?
Well, it's a very good point, Sarah. I mean, when we look at the history of crises and deep recessions, the speed and the assertiveness of policy support has been one of the key ingredients in determining how successful economies are in recovering. And we actually have seen more aggressive action, particularly in the US, than we've seen in general across Europe. So that is one of the reasons I think the US market has done better. Of course, the other factor, and we were mentioning it before, is just the leaders of the market. And in the case of the US, you've got a very high concentration in technology companies, which have tended to do better. And indeed, this has been an unusual rally from a bear market low, because it has been led generally by more defensive growth type companies, very different from most bear market recoveries, where you tend to get more cyclical, more high beta parts of the market leading.
Peter, small caps have clearly underperformed here and around the rest of the world. Does that make sense, or is there an opportunity there? Is the stimulus reaching companies of all sizes?
Well, it's partly, I think, because there are more risks to smaller companies given the scale of the recessions that we're expecting to see. Contractions of well over 5% this year in the US and over 10% in Europe, for example. These are historically large downturns, and that will put more risks on smaller companies, particularly those that might have funding constraints. But I think also, to some degree, it reflects the fairly defensive nature of this rebound that we've seen so far. And that suggests to us that actually the main reason equities have jumped so much from their March lows is mainly because tail risks have been moderated as a result of the policy stimulus, rather than strong increased confidence about future growth. And it's when you get that more greater confidence in the economy that you tend to get mid and small-sized companies doing better, and cyclical companies too. And we haven't yet reached that, I think, in this cycle.
Dow down 331 points. Peter, where in the world do you see the most opportunity right now?
Well, I think we need to sort of separate between sort of shorter and more medium-term prospects. And actually, in the short term, we're relatively cautious of risk assets. We're actually underweight of equities. We're overweight credit in our global asset allocation portfolio, overweight of cash. I think when you do get to a point where there's a more convincing opening up of economies and investors start to really reflect that, you will get a rotation, I think, in markets towards much more cyclical and perhaps higher levered companies. But in the medium to long term, I think we could see some of the factors leading the market in a way that are rather similar to what we've seen in the last decade. And that is probably based on the prospects of relatively low nominal GDP growth and very, very low interest rates. And that combination has been very good for long duration growth companies. And in addition to that, I think high levels of debt, particularly in governments and across the corporate sector, will mean that over the medium to long term, companies with strong balance sheets are likely to be very sought after because they'll have more flexibility to pay out to shareholders in the form of dividends, or indeed to reinvest in terms of future growth. And I think those are the sort of longer term factors that are likely to lead in this next cycle.
Peter, in your book, The Long Goodbye, you provide a deep analysis of market cycles and what drives them. I wonder whether this recent pullback actually acts as the end of the previous cycle, given that we fell so quickly and have rebounded so quickly. Is it, in fact, just an extension of the previous cycle, or is it, are we in a new cycle now? And will the next cycle, because of this enormous stimulus, be shorter than the last one or longer?
That's a great question. I think that we have seen the end of the last cycle. We should be clear that if you take the US as an example, economically, it was the longest expansion for nearly 150 years. And in the stock market, it was the longest bull market for about a century. It came to an end because of the exogenous shock that came about because of this virus. And when you look at the history of bear markets, which I do in the book, we find that there are different types of bear market cycles, which are really a function of what drives them. So they're the event-driven ones that are driven by a shock that derails the economy. There are the ones we call cyclical, which are more typically driven by rising interest rates late in the cycle. And there are those that we call structural, which are nearly always preceded by asset bubbles. And when those burst, you get usually real estate crises and banking crises. Financial crisis was a good example. We find that the structural ones are much deeper and longer. The cyclical ones, you tend to see prices fall 35% or so over a couple of years. Usually takes 4 years to recover. But the event-driven ones also see similar types of falls, around 30 to 35%. But it tends to be over a much shorter period, very much as we've just been experiencing. So I think we have ended the last cycle. I think the next cycle, with the very significant policy support we're seeing, and likely very low rates for a long time, will also be probably quite extended, quite long, but again, probably dominated by relatively low profit growth and economic growth, which will favor certain types of growth companies.
Peter Oppenheimer, thanks so much for joining us.